All right, let's dive right in. Today, we're unpacking the latest Q1 2026 financial results from Upbound Group. You might know them by their ticker symbol UPBD. Now, if you follow the consumer finance space, you already know the macro environment has been pretty rough lately, right? Full of headwinds. But Upbound, they've been navigating these choppy waters with some seriously intriguing strategies. So we're going to break down their quarterly performance, look at those expanding margins, and see exactly what Wall Street expects moving forward. So here's the big question. How do underserved consumers access financial solutions when the doors to traditional credit are just slammed shut? It's a critical problem, one facing millions of people right now. And to really grasp Upbound's investment thesis and their massive scale, we have to understand how they're stepping in to bridge that gap. Honestly, it's all about access, and we're talking about a staggering addressable market here.
Here's our agenda for today. First, we'll meet Upbound Group, then look at the segment breakdown, dive into the Q1 2026 financial results, check out the stock and margin performance, and finally, looking ahead.
Okay, Section 1. Let's meet Upbound Group. At its very core, Upbound is a technology and data-driven leader in inclusive finance. Their mission is actually pretty simple. They want to provide accessible solutions for consumers who typically just don't qualify for traditional credit. And they aren't just your standard retailer. They're actually this really unique fintech hybrid. They're bridging the financial gap through industry-leading lease-to-own platforms alongside digital financial wellness tools across the US, Puerto Rico, and even Mexico.
Moving on to Section 2, the segment breakdown.
Now, Upbound's ecosystem is built on a few distinct but totally complementary revenue pillars. As you can see, Acima is completely leading the charge here, bringing in almost $649 million in Q1 revenue just through digital virtual lease-to-own. Then you've got Rent-A-Center, which really stabilizes their physical retail presence at about $482 million. But you know what the real wildcard is here? Brigit. It brought in nearly $68 million. Upbound acquired this financial wellness app, and man, it is driving some fast-growing, highly scalable subscription revenue for them. This specific blend, digital fintech, recurring subscriptions, and legacy brick and mortar, that's exactly what makes their earnings so incredibly resilient.
Let's get into the numbers. Section 3. Q1 2026 financial results.
Upbound delivered a massive $1.219 billion in consolidated revenue for the first quarter. That actually marks a 3.7% year-over-year increase, essentially adding roughly $43.4 million to the top line. Look, in a historically tough economic environment for the non-prime consumer, seeing this kind of top-line growth, especially paired with a GAAP operating profit margin that expanded to 6.3%, it absolutely proves that their operational execution is genuinely clicking right now.
But hey, revenue is only half the equation, right? Crucially, their operating cash flow for the quarter exceeded $170 million. And if you're looking at this from an investment standpoint, this is the metric that really matters. This robust cash generation is literally the core engine driving Upbound's overall liquidity and their strategic flexibility.
And management didn't just sit on that cash either. As CFO Hao Khoury pointed out, this cash generation supported a really meaningful debt paydown. They actually dropped their net leverage ratio to 2.6x at quarter end, down from 2.9x, all while maintaining a tremendous liquidity cushion of over $460 million. It is basically a textbook example of de-risking a balance sheet while remaining fully funded for future growth.
Which brings us to Section 4, stock and margin performance. You really have to look at this historical turnaround in profitability. Back in 2022 and 2023, their operating margins were severely compressed, just weighed down between 1.32% and 1.45%. But today, the trailing 12-month operating margin has expanded dramatically to 4.10%. They're proving, without a doubt, that they can sell services way more efficiently and control their overhead so much better than they did just a few short years ago. So what's actually driving this margin expansion? Well, a massive piece of the puzzle is their disciplined underwriting. You see, in the lease-to-own space, the ultimate metric is the lease charge-off rate, or LCO. It's essentially the percentage of unrecoverable merchandise. Thanks to some much tighter risk management and advanced data analytics, Acima's LCO rate dropped sequentially by a remarkable 130 basis points, falling below 9%. Put simply, when you lose less inventory, your margins are going to expand.
For us watching the stock, all this financial health translates into a highly compelling valuation. At roughly $22.76 a share right now, the stock trades at a rock-bottom forward PE ratio of just 5.19. That offers a very distinct margin of safety. Add in an annualized dividend of $1.56, which is yielding over 7% by the way, and you have a pretty powerful total return profile. Honestly, it's really no surprise the analyst consensus is a strong buy. With an average 12-month price target of $28.64, that implies over 25% upside from current level.
Finally, Section 5. Looking ahead.
Despite a notoriously challenging macroeconomic backdrop, Upbound's management is holding the line and reaffirming their full-year guidance. They're signaling absolute confidence in generating nearly $5 billion in consolidated revenue, alongside a robust adjusted EBITDA of well over $500 million. Forecasting an adjusted EPS of up to $4.53 for the year, that really proves the momentum we saw in Q1. That digital growth, those Bridget subscriptions, and a stabilized retail footprint, it's all built to weather the storm.
And this brings us to the big picture. Upbound is rapidly scaling digital platforms like Acima and subscription models like Bridget, right alongside their legacy Rent-A-Center stores. By actively lowering risk, expanding their margins, and generating massive cash flow, they are completely rewriting the playbook here. So the real question is, as traditional credit continues to tighten up, is this hybrid tech and store model the ultimate blueprint for the future of inclusive finance? Let me know what you think.